All right, today we're going to pull back the curtain on something you've probably seen all over the internet, prop trading firms. It's an industry that basically promises a golden ticket to the big leagues of trading. But is that promise for real, or is there a hidden catch? Let's dig in and find out. Yeah, you've definitely seen ads like this, right? Trade with our capital. Keep up to 90% of the profits. I mean, come on, that is a powerful pitch. The whole idea that you can trade a massive account, we're talking hundreds of thousands of dollars, without risking a single cent of your own cash, and then you get to keep almost all the winnings, it sounds a little too good to be true, doesn't it? And that's the million-dollar question, isn't it? How on earth can a company afford to give away 90% of the profits from trading its own money? What's the catch here? Well, to figure that out, we've got to get on the same page about what these firms actually are. So at its core, what we're talking about here is a company that vets traders through some kind of challenge or evaluation. If you manage to pass, they fund you with a big trading account. And this model, it's completely blown the doors open for people all over the world, giving them access to trading capital like never before. Okay, so let's start with the promise. Let's talk about the incredible appeal of this whole thing. What is it about this model that has pulled in hundreds of thousands of aspiring traders and turned this into a multi-billion-dollar industry in just a few short years? It's pretty wild. It really comes down to this powerful mix of opportunity and, well, safety. Think about it. For a relatively small fee, you get a legitimate shot at trading a six-figure account. You're not putting your life savings on the line. And with those profit splits going as high as 90%, the upside feels absolutely limitless. It's this direct path for basically anyone, anywhere, to maybe, just maybe, become a full-time trader. Okay, but here's the thing. Before you get the keys to the kingdom, you have to prove you're worthy. And this is where the dream slams right into a very harsh reality. We're talking about the evaluation process, which a lot of traders just call the grinder. So this is the standard gauntlet that most of these firms are going to put you through. Phase 1 is basically a sprint. You have to show you can make money and make it fast, usually targeting something like an 8 or 10% gain. But then phase 2, that's more of a marathon. You've got to prove that your first success wasn't just a fluke, a lucky break. The whole thing is designed to filter for both your skill and your discipline. But listen, it's not just about hitting that profit target. Oh no. You have to do it while navigating a total minefield of rules. And that maximum daily loss rule, it is particularly brutal. You could be crushing it. Maybe you're up 9% on the challenge, and then you have one bad day where you lose 5% and boom, you're out. Game over. These super strict, non-negotiable limits are exactly why the vast majority of people fail. And that super high failure rate, well, that brings us to the absolute core of this whole thing. We're about to pull back the curtain on the real financial engine that powers this entire industry. This is the part where it's all going to click into place. So let's circle back to that central mystery. If hardly anyone passes these things, and the tiny few who do get to keep almost all the money they make, how does a prop firm even stay in business, let alone become massively profitable? It doesn't seem to add up. And here's the answer. The overwhelming majority of a prop firm's money, we're talking around 70%, it doesn't come from successful trading profits. Not at all. It comes from the evaluation fees, the fees paid by the tens of thousands of traders who try and fail. The business isn't really funded by profits. It's funded by aspirations. But wait, there's another critical piece to this puzzle. It turns out most traders, even a lot of the ones who get funded, they aren't actually trading real money. They're on a simulated account, a demo account. The firm just copies the trades of its very best performers over to a live account. So what does this mean? It means the firm's actual risk on a $100,000 account isn't $100,000. No way. It's limited to whatever that maximum allowed loss is. Maybe $10,000. And this quote from the trading education site Baby Pips, man, it just sums it up perfectly. You pay the firm, you're effectively paying for drawdown capital. So that fee you pay for a challenge, you're not buying a pile of cash. You're buying permission to trade within a specific risk limit. You are literally paying for the right to lose a certain amount of the firm's simulated money. Okay, so after hearing all that, you might be thinking, is it even possible to succeed? And look, the odds are daunting, for sure, but they're not zero. So let's flip the script. Let's shift our perspective now and look at that tiny fraction of traders who actually make it through and get a payout. What in the world are they doing differently? This right here, this funnel, it just lays out the brutal reality of this situation. You've got 100% of traders starting at the top, full of hope. But only about 5 to 10% actually make it through the evaluation. And here's the kicker. Passing isn't the finish line, not even close. A lot of those who get funded will quickly break a rule and just fall right out of the funnel, losing their account. And this is probably the single most important number to remember in all of this, 7%. Across the entire industry, the data shows that only about 7% of people who sign up for one of these challenges will ever see a single dollar in payouts. That's it. It's an incredibly selective process, whether you think that's by design or just the brutal nature of trading itself. So, how do you become one of the 7%? What's the secret sauce? Well, it's not about being some genius market predictor. The data is crystal clear. Success comes down to extreme, almost boring, discipline. We're talking about traders who risk less than 1% per trade. They have a 40% higher chance of passing. People who practice the challenge conditions in a demo account first, and who maintain that psychological discipline. Simple stuff like taking a break after a loss. They dramatically reduce their chances of breaking the rules.
Okay, so let's zoom out for a second and look at the big picture. This industry has had an absolutely wild ride, right? It went from being this tiny, niche idea to a global phenomenon in less than a decade. So the big question is, what does the future hold for prop trading?
If you look at the timeline, back in the mid-2010s, you had the pioneers, firms like FTMO, who basically established this online challenge model. Then, COVID happened. The pandemic trading boom created this absolutely explosive growth, with dozens of new firms popping up. But now the industry is starting to mature. We're seeing consolidation, weaker firms are shutting down, and for the very first time, we're seeing serious scrutiny from regulators who are finally starting to ask some tough questions.
And make no mistake, the stakes here are incredibly high. We are talking about a global industry valued at over $12 billion. And while the US and the UK are the biggest markets right now, the fastest growth is actually happening in emerging economies, places in Asia, Africa, and Latin America, where this model offers just unprecedented access to capital. So this all leaves us with a really big question. Is this whole industry a genuine meritocracy that gives skilled traders a real shot at life-changing money? Or is it just a sophisticated numbers game where the house almost always wins because the business model relies on the vast majority of people losing? The truth is, it's probably a bit of both. It's a high-stakes system for sure, where the rules are set by the house. But it's also a system where true, hardcore discipline can, against all odds, still win. So maybe the ultimate question isn't just about the industry. Maybe it's about the trader. Are they playing the firm's game, or are they playing their own?